Good morning, everybody. Welcome to the Flow Show. Sorry, a bit of a pause there at the start. There was just a headline crossing the squawk. Apparently, some of this yen moves are traders unwinding short positions in the yen, apparently, according to someone somewhere. So we'll have to see where that continues to play out. But we're definitely seeing some yen strength coming in this morning. Anyway, morning, Kate. Morning, Stel.
Good morning, everybody.
Hello, good morning.
Yeah, those people must have found a way to look at our chat room, mate. We've been talking the whole day. I've been talking the whole day yesterday about carry trade unwind. If you look at the mix, it's I think there's a lot of mix yen going on, euro mix going on. Because the Mexican peso got hit pretty hard yesterday. So those people must have been having a view on our chat room. Check the security settings, Del.
Check the tape.
Check the tapes. So that takes me back, mate.
Yeah, it does. Check the tapes. Oh dear. All right, let's get right into it. We've obviously got a lot to talk about with the old NFPs coming up, so we can get stuck into that. But we shall start as we always do in China. They set the midpoint at 720.54, so still keeping it around that 720 mark, even though the actual rate is much higher. China's Premier Li says China's economy is rebounding and they will implement targeted fiscal policies to stabilize growth. He's also meeting Yellen sometime today, I think, now at the moment, as part of Yellen's whistle-stop tour to China. On that front, Yellen is apparently going to address unfair practices by China, some of which include the recent punitive actions against US firms and barriers to market access. Woohoo! That sounds interesting. But anyway, Yellen's over there in meetings. We'll see if there's any comments dropping that give us any moves in risk. Now, something I missed yesterday, and that one of our readers put in the room, or one of our roomies put in the room, Gavin, been looking for whether there's going to be any offshoring of dollars, any outflows from mainland China, and apparently there has been. There's been a pickup in dollars running into Hong Kong, going into various other investment products like insurance, because there's higher rates over there. There's some products that will get you 4% returns or yield of 4% on dollar deposits in those assets, compared to leaving them in China at the reduced rate of 2.8%. So there is apparently a pickup in offshoring going on over there. We'll have to see whether China brings the boot down on that by increasing capital controls and tightening the net as to what can leave China. It doesn't have any real FX impact because it's just moving dollars from one pot to another. But it is something that China is going to be on top of as part of what's going on with the currency moves. And on that front, there has been some stronger talk that they will step in and defend the yuan if necessary, but that's according to experts speaking about China affairs. That's not coming from officials, even though it's reported in the China Daily Press. So we've still got this sword hanging over whether they actually put a stop to all this one weakness. At the moment, it's still in the camp of just slowing any further slides we get there. Over to the Bank of Japan, and Uchida was out and talking about what they may do with monetary policy, and it's been taken largely dovish, although you could say some of it was, I wouldn't call it hawkish, but a bit more balanced. He said, we want to make a balanced decision on tweaking this policy, talking about YCC. Want to keep an eye on monetary interventions and market functions, and on how well we maintain monetary easing. So talking about what they may do or look for if they do unwind policy. But then he chucked in the old line, we will continue with YCC for the time being. and then said, I think there is more risk to scaling back on easing too hastily and failing to meet the 2% inflation target than to tighten too slowly and seeing inflation remain above 2%. So overall, dovish or continued easing comments from him. Bit of a surprise that the yen didn't weaken on those sort of comments, considering we have got the upcoming BOJ this month. Then we got some other comments. Mr. Yen, as he's been called, Sakakibara, says Japan's currency may weaken to 160 and beyond on the wider monetary policy divergence with the US. Another former BOJ economist, Kameda, said the BOJ is likely to forgo YCC tweak in July despite broadening inflation. So lots of comments still sounding dovish, but the yen is not reacting as we know it often does with further weakness. There's some things going on in the yen at the moment, which we'll discuss shortly. What may be helping a bit of yen strength is that labour earnings for May came in pretty strong, came in at 2.5% year on year. These numbers pretty much the same, average cash earnings over wages, 2.5%, a massive beat of expectations and on the prior month. Now, you've got to look at the detail, and real cash earnings, which is not in that list there, came in at minus 1.2%. However, that wasn't as bad as the estimated minus 2.7%, nor the prior minus 3.2%. So we can see the impact now of these wage increases that we saw in Japan filtering through into the real numbers. Real earnings still at a negative, but the gap is closing. And this is what Kishida wants to see. He's going to keep on pumping, getting wages higher in the next fiscal year as well. We're going to have to wait a while for that. But the gap is closing. As long as inflation doesn't start pulling back too swiftly, then potentially that gap is going to close. And when we get wages in positive terms, in a real sense, maybe that's the time when the BOJ will start to think about changing policy. Obviously, if that comes with inflation still above their target. On the spending front, though, it wasn't looking so good. Month on month, down 1.1%. Year on year, down 4%. Okay, what do you make of the spending numbers? Might that be an impact of inflation? You know, it doesn't look big going from, you know, when it's saying around 3% compared to 9-10s that we've seen in Europe, US and whatnot. But does it have a big impact, small rises in inflation?
Well, it could, but then if you look at those spending numbers, take apart the 2021 period and then a part of 2022, those spending numbers in Japan are always looking a little bit anemic over time. What surprised me really in the earnings numbers is that how could they possibly only expect 0.7% hike if we know that over the turn of the fiscal year, start of the fiscal year in Japan, April, May, the unions, well, they call them the unions over there, it's a different name, but they managed to get 3.8% increase in wages. So I don't understand why they were expecting only 0.7%. I think the 2.5 must have been much closer to reality. That for one. And then yeah, the spending I think must be a little linked to the scare in inflation. And again, if you look at the how they behaved, those spending numbers, if you go back onto that other chart that you were looking at, that jump in 2022 from August until, well, roughly December, but in December it was close to zero again. That coincides with when the inflation started to pick up in Japan, which led to Kuroda going out with a bang in one of his last meetings and widening the YCC. So there's a bit of this pattern, but now it's done, and now that Ueda keeps everything at a standstill for now, and seen inflation is still running very hot. Yeah, that's probably reflected in those household spendings. But really, the the household spending in Japan is, I wouldn't compare it to the European consumer confidence, but it's anemic at best most of times, you know.
Yeah, thanks, mate. Yeah, I was going to say there's not numbers they want to be tightening policy into, negative spending numbers, things like retail sales and the like. You know, it's a bit different to the US and other countries where there's been some positive numbers on that front. You got yourself a bit of margin. They're going to have probably a very fine margin with any tightening of policy and that impact on the economy. Generally, that will play into their thinking, no doubt, if and when they decide to exit their easing program. But we'll have to wait and see for that one.
The issue is it is Japan. They don't do things like anyone else is doing.
Yeah.
If you would compare it to the US, to Europe, to the UK, to even Australia and New Zealand, which are closer to their home. They have been very, very dynamic in raising interest rates, but Japan is just such a slow mover. They've been struggling for decades, and it's just such slow move. Although we have been calling it for over a year now that the window is open for them to do something. But here we are. We're still in the same situation.
Yeah, and as you say, the window stays open. Let's hope we don't catch a cold when winter comes. But anyway, right, coming over to the UK, and rate hike expectations continue to grow. We're now pricing a 50 pip hike in August. Rates probabilities for that increasing. Now, market sees a 50% chance of a 6.75 peak. So the peak rate moving up as well now. Interest rate swaps show a 53% chance of rates reaching 6.5% by December 2023 and 80% chance, or larger than 80% chance, by March 2024. I'm going to be repeating myself again. I think these rate expectations are getting very extreme. Unfortunately, we're not really seeing that reflected in the pound too much, apart from the fact that it refuses to go down. But there's no extreme moves higher in the quid, and I'm looking for that to start scaling in some shorts, because I think, as I say, been saying for a while now, these rate expectations are getting very toppy, and I'm getting an itch to fight them. Maybe I'll have to just put some on to get rid of the FOMO, put a little short on, and then scale in further levels if they're seen. But yeah, we still keep going up in these rate expectations, and the market loves to run too far to one side of the boat, doesn't it, Stel? As much as I know you're bullish the quid, more so probably the mentals, but these rate expectations, they're getting a bit too much, aren't they?
They are, but on the other hand, the data is kind of justifying them. But yes, I think you're right. And as the central banks were too slow to start, I think they're going to be too slow to finish, and they're going to be chasing it the other way once they decide to go. But anyway, I will talk about the Fed as well. And guys, I left you for a day. You broke everything. The markets are going ballistic.
Well, that'll teach you, won't it?
Yeah.
We got to do something while you weren't here, so we thought we'd break. And it wasn't me; it was Kay. So blame him. Nothing to do with me. I wasn't there. Yeah. So anyway, yeah, that's my thoughts on the quids. And like you say, we'll talk about the other banks shortly. Over to the ECB. Lagarde says the ECB won't stand idly by if margins and wages rise. So the wage comments are coming into quite a few ECB members speeches now, and that's something they're going to be keeping a close eye on, whether there's the start of a wage spiral, which is something that is obviously in effect in the UK as well at the moment, with all the strikes and resolutions and so on. ECB's De Guindos says the bulk of the impact of our tightening is expected to materialise only in the course of this year and thereafter. So he's still expecting to see some of these effects from hikes coming through later. There is always a lag between policy moves and when it's seen in economies and in conditions, which makes it a bit of a folly when you've got central banks like the RBA hiking 1 month, pausing the next, hiking the next month. It just doesn't give enough time to see the course of those actions. But those guys are clowns anyway. They weren't supposed to raise rates until next year. So look how they did with that. Anyway, enough RBA bashing. And I like to bash them sometimes. Coming over to the data and that big old surprise in the ADP numbers, a whopping 497 versus 228k previously. And I did say yesterday that this ADP number is a funny one. It's not a linear one-to-one correlation with the NFP. And when it comes in there or thereabouts expectations, the market tends to ignore it. Even minor beats and misses, it tends to ignore. But when you get a big outlier number, that gets the market moving and it gets expectations running for NFP. And thus we got exactly that happening. A big 497k beat there for ADP, and that's got people scaling up expectations for the NFP for that. Now, before we get into the NFP stuff, just wanted to point out something from the ADP report. This report was pretty good for showing exactly what's going on in the fundamentals. So take up here, we know manufacturing has been in a slump, so it's no great shock to see that people are being laid off, down 42,000 in manufacturing. Construction, we know the housing market has picked up. We know it didn't really suffer greatly over the rate hikes that we had previously. We saw some weakness earlier in the year, but it's picked up again. No surprise to see job gains coming in there. So if you look at things sector by sector, you can sort of see how it's playing out and how it's matching what we're seeing in things like the PMIs. Now, another side of the coin is that the main driver behind these rises in ADP numbers has been this leisure and hospitality. It's been the biggest gainer over pretty much the last few months in reports. Now, what again stands out is that leisure and hospitality tends to be at the lower end of the pay scale. So you're thinking waiters,
and part-time too,
part-time and yes, things like that. So when you're talking about actual economics, it's at the lower end of the pay grade. Things like information, financial activities, professional business services, they're at the, you could say, the higher end of the pay scale. They're the ones that are losing jobs. So in effect, you're taking potentially out a lot of high earners and putting in a lot of low earners. That's not usually a good recipe for economic activity. And this has been a trend that's been running for a while as well. So it's something we need to keep an eye on in terms of the jobs data, because if there is a downturn, it's going to be these people in leisure hospitality, they're going to be the first ones out the door. And then that's where you're going to see a big impact in jobs, because if we suddenly get a negative number and this one's dropped by 200,000, it's going to change the whole picture for the jobs market, especially if the rest of the numbers keep coming in negatives. So it's just something to look at in the detail of the data. It's okay trading on the headline, yeah, 497, everything looks fine and dandy. Sometimes you need to dip into the details just to see what's going on and to understand, are there any red flags potentially coming up? For me, this is a potential red flag, seeing that these numbers continuing to increase, particularly, as I say, in the lower end of the pay scale. Now, speaking of the pay scale,
I'd like to add a couple of comments afterwards when you're done about the job. So carry on, and then I'll add a couple of comments.
Yeah, the other thing in the ADP report was that annual pay was up 6.4%, although that was down from 6.7% in the May report. So may have come down a bit, the rate of pay increases, but that's still a hefty number, running in the 6%. That puts real pay in the positive if you take inflation into account. So that's something potentially, again, for the Fed to keep an eye on, wages as a potential secondary driver to inflation. Go on, Dale.
So I was going to add a couple of things. So I saw the headline number. I was driving at the time, and I saw the market reaction. And there's a few things to consider. One, in the US at the moment, there's a record number of people with multiple jobs. You know, you have a part-time jobs, 2 or 3 jobs, and people work from home and all that. These are all double and triple counted. Is also, I was watching a video by Danielle DiMartino Booth, who I really, really like, and she was saying that a lot of people have been sacked from finance and tech industries, are still on their previous employer's payroll, but they've found a job elsewhere. So they are double counted as well. There's a lot of evidence that's pointing to really strong or big deterioration of the quality of employment. We've said this for a while. And what we have to do is take a step back and look at where inflation has been for the last year or two, and where where earnings growth has been. And I think we can all agree inflation has been higher, quite a bit higher than earnings growth. So what is the average person feeling in terms of disposable income? Is it growing or is it shrinking? I think we can all agree that disposable income is shrinking. I'm not talking about the top 5%. I'm talking about the majority of people. So what are people having to do? They're having to find a second and a third job, part-time job here, part-time job there. And you're seeing these employment numbers go to the moon. Is this good? This is not good. So we have to keep in mind, what is the driver for this? What is the driver for these numbers? And the driver is not good. And in the short term, we're seeing an increase in job numbers. But because of the stuff you talked about as well, Ryan, very correctly, I think once this leisure / hospitality starts pulling back, which it will eventually, unavoidably, then there's going to be all sorts of trouble, because we've got rid of high-paying jobs and we're creating low-paying jobs. So we have to be very careful about what this means, these numbers mean. And also one more thing. I've said this so many times. Why was the Fed hiking rates like crazy? Was it because jobs were high? No. It was because inflation has been going through the roof. If you look at the job numbers, ADP or NFP, if you go back a couple of years, so after COVID, which was a spike, there have been ups and downs. If you go to the 2-year, because that spike messes up the chart. If you go to the 2-year, and the NFP is actually a lot smoother. There's outliers up and down, but really you are relatively stable. So it wasn't the NFP or the ADP or the employment in general that has been causing the Fed to hike like crazy. It was inflation. What is inflation doing? It's going down. We're expecting 3 and change % for the next print. So this is what I am concentrating on. And I see the market. Look at the NFPs, right? They're relatively stable. Okay, you have the odd outlier, below 200 or above 400, something like that, but the average is about 300 for 2 years now. So it's not really employment that's been driving the Fed to hike like crazy. So I'm looking at inflation, and I still think that inflation is going to keep dropping. Headline for sure, the core as well, slowly. And this is, I think, what the Fed are looking at. It's not employment. They're not going to be hiking like crazy or continuing to hike because employment, the NFPs are showing, or the ADP is showing more jobs. They're going to think. They're not idiots. Well, I'd like to think they're not idiots. They're going to think, what's the driver of this? What's the issue with the economy? What's the risk? Do they think there's a risk of all these more jobs creating more inflation in terms of demand-based inflation from the average consumer? Of course not. People are having trouble making ends meet. So, I'm talking about the average person. I'm not talking about the bottom 10% or the top 10%. Anyway, rant over. I just think the market's putting way too much emphasis on these employment numbers. They should be looking at inflation a lot more. I would argue 90% inflation, 10% employment really is what we should be seeing in terms of the driver for the Fed. But anyway, let's see.
Yeah, no, I agree with that, and you make a particularly good point. I mean, the risk is that wage increases do continue and go higher, because that's going to be a secondary win for inflation, much like we've got here in the UK. That part of the employment situation, I think they're worried about. Because I think one of the other things is there's been a big drawdown in savings. You know, you're talking about how is your average Joe living? Well, they built up tons of savings over COVID and whatnot, and they're getting eaten away now. So that shows, again, a drain on income, because if you're having to dip into savings, your income isn't covering your bills. And again, that's another factor that we have to look at to see when things are going to turn, particularly for central banks. And as we said, you know, there's times when there's good jobs data and times when there's good numbers, but the data isn't so good. And I think that shows up in the ADP, that although it looks good on the surface, 497, wow, brilliant. You look at the details and you think, and like you've mentioned, with double counting and people taking second jobs, there are some red flags popping up. And it doesn't take much for those to tip over, and suddenly you go from a solid jobs market to a really negative jobs market. And 5 minutes later, everyone's pricing cuts, dollars getting hammered, yields are getting hammered, and we do a complete 180. The key for us trading it is looking at those numbers and getting in there early, seeing when the turns are coming. If we get another couple of reports where it's not looking so good, and you know, where the numbers suggest that it's still bad looking good employment, then that's when I'm going to start thinking about counter trading, what the Fed's doing, what everyone else is expecting. Because that's when you catch the big trends, if you get in early enough for that. And that's why, part of the reason why we do this show, to give a bit more of a fundamental slant to things, to try and show people and you know, explain what the actual fundamentals mean, when you can use them to decide when to trade. You know, everyone can sit there and go, well, I think the Eurozone is fucked, but you need to look at the data, and the data will tell you when it really is fucked and when it's not fucked. Because you can trade your opinion all day long. I'd rather trade the data, because that gives me the early ins. Anyway, moving on, unless, Kay, you got anything you wanted to add to the jobs front?
No, mate. I mean, it's you guys have raised some extremely valid points that we are regularly discussing everywhere on all the shows and stuff. I just wanted to say the only thing that I'm going to say it's not to counter anything, but we can't forget that the market is really suffering from collective Alzheimer, and they do look at the headline numbers, and then it's going to take somebody or multiple warnings of people to rub their nose in things before they really turn. So trading it can be a lengthy wait, as we know, because we've been, and especially still Steve actually as well has been talking about that. I think, when was it, like even end of the year, start of this year as well, for sure, when we had those huge revisions, remember, on the NFP, where we had like a massive bump higher. There was already a lot of warnings about people having like secondary, third jobs, and I reckon in the ADP that's reflected as well. And where we also saw, and that is something that we've been talking about, the gap between services and manufacturing seems to be widening on the jobs front too, not only in the PMIs from the company side, but on the job side as well. So that is something to keep an eye on as well, for if ever those services jobs are starting to decline, then it could all of a sudden look like a pretty sour picture. Yeah, and that's about it. The difficulty is to trade it, really to trade it. If you look at what's happened yesterday on the numbers, and where I'm a little surprised is not so much the ADP, but that we got the ISM services beating everything, and the dollar still couldn't keep a bid. That was a little surprising, unless the major players are watching the jobs report, which is to come up now, to just make a decision on the global package. You know, we've had the same thing on the Fed and the Fed and the ECB. Remember, the Fed was a bit of a no-show, but then the combination of the Fed and the ECB, and then we had that claims number all of a sudden coming out. We were discussing it live, which was really the kicker. So perhaps we are waiting for this NFP number today to show up, and then see what the big boys or girls want to do with everything. I think that's a possibility this afternoon. So I don't discount a big move this afternoon.
Yeah, no, I agree with that. I agree with that. And as you can see there from the ISM numbers, really positive data, really strong data from there. You know, the market might have been leaning a little bit the other way, considering what we'd seen in Europe and other countries in terms of services just easing off a bit. But it came in a lovely 53.9 versus 51 expected. Employment up, prices paid down, but not as much as expected. So overall, it was perfect soft landing data for the Fed. And the dollar rallied initially, yield rallied, and then it all started going the other way. Well, apart from yields. Jolts was also another number that plays well into the Fed's hands. We had a pullback under 10 million again. The ratio between jobs unemployed closing as well. And again, that's positive signs for the Fed. Now, on the rate markets, we have actually started to price now a November rate hike. I think this might have changed a bit since yesterday, but yesterday the CME FedWatch numbers showed a 46% chance of the NOV hike, up from 36% the prior day. Those I think have increased a bit further. I'll have to double check. But now we're pricing a November hike. So the market may be sensing a June hike, a pause, and then a winter hike if the data keeps moving in the way it is doing. Where am I? Yep. So, okay. So US stuff, we'll look at the price action in a moment. Last thing really is the BOC. They're expected to raise rates 25 pips next week. Their meeting is July the 12th. That's according to 20 out of 24 economists, with the other 4 saying they're going to go on hold. Geopolitics, there was a story out which I'm surprised didn't get much reaction in markets, because apparently some former US officials have held secret Ukraine talks with prominent Russians. I thought this might see a move in risk, because they want to be talking about potential peace and ceasing the war, and that was out from NBC, so we don't know how reliable that is regarding sources, but that was a headline that dropped. And for those who are still caught up in the Twitter mess, apparently Twitter sent a cease and desist letter to Meta over their new Threads app. So maybe this cage fight between Musk and Zuckerberg is going to happen in the courts rather than actually in a ring. So we wait to see what happens.
Did you say Zuckerberg or Zuckerberg?
Sucker.
Okay, nice. I like.
Why not? So that's what's going on in the Twitter world. Bum fights all around. Anyway, Mike just asked over the ADP. Has a strong ADP blunted a strong NFP number effect? I think what it's done, it will have the market naturally thinking that if we get a higher number, that's largely expected. What the ADP's done is put the risk to the downside. If we get a negative number, and I think even a minor miss, something like coming in at 100k, I think that will do some damage. Whereas if ADP had come out as expected and non-farms had come out at 100k, it wouldn't have had that much price action move, because it's still a positive number. But now I think sights have been set a little higher. It opens the door for a bigger move on disappointment if it's a miss. If it comes in 400k, 500k, the market will go, yeah, well, the ADP showed us that. So it may be limited upside as far as dollar and yields are concerned, or it could be a bit stronger move because it's confirmation that jobs and everything's looking good. But as always, what we have to do is peel through the details. So outside of the headline number, that comes in. We need to look at the unemployment rate, which had that surprise move to 3.7%. Is expected to fall back again this month. The participation rate is going to be important for judging the unemployment rate. So if the participation rate rises, that can mean the unemployment rate rises. Now, if the unemployment rate goes up because the participation rate goes up, that's not necessarily a bad thing. It means more people are coming into the jobs market and looking for work. That's what's boosted the unemployment rate. The perfect good storm is when you get the participation rate going up, but the unemployment rate coming down. So that shows that even with people coming back in, there's still more people getting jobs. From that, we always have to look at the wage numbers, expected to drop a pip to 4.3%. If they come in much weaker than that, that plays into the inflation trade. So that suggests that inflation pressures from wages are dissipating somewhat, which means the Fed can take a longer pause if they so wish. Stronger numbers, the opposite. So pretty much you look at earnings as an inflationary number. If it's hot, it means the Fed's going to keep hiking or keep hawkish. If it's soft, then that takes some of the hawkishness out of the Fed. So you start with the headline, you go with the unemployment participation rate, then you look at the wages, and then you add it all up and you decide which one is the one you want to move on, or the one that the market is going to be trading. You know, if we get a soft 100k NFP, the market will likely sell dollars initially on that. But if wages are strong, if unemployment's strong, if participation rate is good as well, you might see a flip around because the market will trade the inflationary aspect for that, and that the NFP number is the least important out of all the rest of the numbers. And obviously, if you're trading the loonie, keep an eye on the Canadian jobs as well. Same sort of thing, participation rate, unemployment rate. Look at the revolving door between full-time and part-time. A strong trend is seeing positive full-times and positive or even negative part-times, unless the balance is more into the negative. But you want to see a strong trend in full-time jobs rather than part-time jobs. So come on, guys, what have you picked for the NFP compo?
I think I picked 169, which looks a bit low now.
Ah, come on.
No changes.
But I'll stick with it. I agree. I think regarding ADP kind of taking the strong number effect for NFP today, I kind of agree. I think it needs to be the expectations for 225, but really anybody you speak to, they're all saying, yeah, 300 plus now. So I don't know what to make of it. Kay, what do you think?
I picked 222 before the ADP, as soon as the poll came out, and I'm going to stick to my guns because we have seen in the past that ADP is not really 100% correlated with the NFPs. So I picked 222, bit of a mellow number, and actually I don't know what's going to happen if everything comes out as expected this afternoon. I think I'd rather trade Canadian dollar this afternoon than US dollar, perhaps. Yeah, it's after what I saw yesterday, but again, and maybe the bigger players are just waiting for this job report to react on both days combined. But it was a bit of a strange reaction, and I would argue, especially after the ISM. So yeah, I don't know what's going to happen if the number just comes out as expected. The obvious observation now, kicking in an open door, is that the negative number is going to have a much bigger impact than a positive number. So yeah. We have to be a little bit on our toes. Stuff like dollar yen is already a little bit weaker for several reasons. We have spoken about those reasons yesterday already, and they're still ongoing. But there's also the other reason that carry trades are being unwound, which I also mentioned yesterday already. But there's one that is really a bit strange to me, particularly yesterday, is that we've already said that in the past, and I've already touched on that in the past, that the bond market is one big pot of gnat. If you see what happened yesterday to the euro yields and to the sterling yields for different reasons, of course, because they are how shall I say, anticipating more Bank of England rate hikes, but even the European yields have shot up when the US data came out. So it's really, the bond market is one big pot now, because there was no reason at all for the European yields to go higher yesterday, but they did, and that's what keeping the euro dollar really stuck right now. The differentials are absolutely going nowhere. So in that respect, I've got my eye on this jobs report in the US, because if really there's a beat, and it's a completely US thing, because we have seen the European data being like average at best this week, it may be the straw that finally breaks the camel back in the euro dollar, more specifically. So there is interest on several possibilities in this number this afternoon on the US data. Again, we've been repeating it like a broken record. It's one of the dominoes that still refuses to fall. But if it starts to fall, it could really drag markets in a bit of a rethink again after these numbers. So it will have its importance. But I don't see too much of a reason to change my opinion on the outcome today after the ADP yesterday.
No, this would be a real good time for a real crappy NFP after that ADP number. I mean, that would be carnage. If we get a negative, I don't know, negative 100K NFP, I can see there'll be absolutely carnage this afternoon in markets, because that will just have everyone rushing to the other side of the boat. And I don't know where dollar yen will be, might be down at 140 pretty quickly.
Yeah.
141's that sort of area, but you know, that's just hypothetical. For the record, I've gone for 23K on the NFP just because I like to be different, and it's a 23. That's me. Okay. 23. So
did you have your usual zero from our Greek friend or not?
No, he's not been about, old Kurdy, with his NFP guesses. I think we can take it as standard that his number's 0.
Mm-hmm.
But yeah, my number was also before the ADP, so I wasn't taking that into consideration. I still would have gone with 23 anyway. And just for those who haven't had a crack yet, I've just put the link up in the Zoom chat for the NFP competition. Get on there, win a prize if you get closest to the number. So yeah, it really is a bit messy in markets at the moment. The usual correlations, you tend to see, you know, the odd correlation breaking down. But at the moment, we seem to have a lot of the correlations breaking down. For example, as Kay mentioned, dollar yield, you know, US yields rising up. The dollar went with it over the data, but now here we are much lower. And US yields are still well up. If you look at the 10s, still hovering well above 4%, and not looking like they're coming down. So that's a bit of a correlation breakdown. Another correlation breakdown we've got is dollar weakness here. We've got dollar weakness in cable. We've got some dollar weakness in euro. We've got dollar strength in the CAD, and that's a correlation breakdown because we're seeing oil on the rise. So usually CAD gains if oil's moving higher. But here we are with dollar CAD reaching quite some lofty levels, breaking 133, a line a lot of us looking at and not looking back, not even sticking around. It boom, it went, and there was no questions asked. And here we are, maybe looking at 134. And as you can see, oil's coming up as well. Why is oil rising? No idea. There's absolutely no fundamental reasons I can see to say why oil should start gaining. What it is looking like is good old-fashioned risk off. Over the past year or so, risk off usually saw the dollar getting bought, but seems like old-fashioned risk off, where you see the yen get bought, where you see oil rising. But it's a question of different correlations not playing ball. You know, the dollar is looking a bit weaker, but then you look at Aussie dollar, it's not really bouncing that much. We're up, what, 30 pips this morning. Again, this is a commodity currency, so it's going the opposite way of what the CAD is. So it's all, for me, looking around, and that's what I do when I sit down in the morning. I say, right, which wind is blowing in what direction, and who's leading who, and that gives me an idea of which way the market is leaning each and every day. We know the wider trends. We know fundamentally the US is looking pretty good in its economy. That should mean dollar strength. That should mean higher yields. We're getting the high yields. We're not getting the dollar side. We know that the Japan, okay, some good wage data, but the BOJ is still in easy mode. There's still a big policy divergence between the US and Japan. There's no real reason why yen should be strengthening. So when you look at the wider picture and you think there's nothing changed there, why am I seeing a difference in what's happening in the price action? Something else must be going on. And we had this discussion in our room this morning. It's okay to say, well, okay, the dollar should get strong at some point, but how are you going to trade that? You're going to keep guessing when it's going to get strong, keep trading it based on what you think. That's not the way to play it. The markets can stay irrational far longer than you can stay solvent, is a well-known saying in markets. So how do you play it? If you don't think that what's happening today is part of the longer trend, you have to go to the techs. That's what I do. So am I interested in fighting it down here at these levels? No, but I might be more interested in fighting it if we see a move down to 140s or 141s, the bigger, stronger areas. You know, I've got some lines in here, 142.20s. That might be an area you might want to fight it, but I wouldn't piss against the wind with a big trade. If it breaks, I'd have a stop not too far underneath. If I'm going to play against the short-term sentiment, I'm going to keep my risk low in case I'm wrong. But I'm going to use the techs as my guesses as to whether the moves are over or not. So for me today, I'm going to look at what the data does. I am looking to exit the door pretty quickly, so I'm not sure I'm going to do much trading this afternoon. But I'll keep an eye on things and see if there's any choice numbers. I think perhaps if we get a decent move south on a bad number, it may be worth picking up some dollar yen if we see some decent levels. Conversely, cable again, I'm still itching to get in a bit of a short. So if we see a strong move up on some weakness, I may start scaling in, maybe in cable, maybe in euro sterling, if that heads much lower. How are you guys seeing markets this morning?
What are we going to be doing with the NFT? You mean?
No, just generally, like how you see things set at the moment. Are these moves just short term noise in the longer term flows, or
in a word, I think yes. For me, the big number is still the CPI and then the Fed. So we are getting chop from these employment numbers, but I don't think we're going to be making any real progress. Having said that, 10-year yield has broken out. The question now is, as we've been saying, is this going to be a false break or not? And that will depend on inflation, I think. So what do I think about, the dollar? Well, the dollar, like you said, yields are going higher, but that's going nowhere. So it's very difficult to say that there is any clear direction on the dollar. So I think picking your levels and looking for good longs or shorts depending on which way around you want to do it is the right way to do it. But with a short-term horizon, I think it's a day trader's market, or at least a short-term trader's market at the moment. That's why I'm doing very little.
Yeah, thanks, mate. Kay, how are you seeing things? Do you want to do a quick chart grab? Do a couple of pairs maybe?
I can. I'm going to try and keep it short, but I want to.
By the way, guys, sorry to interrupt. I have to take a call, so I'll let you finish up, and I'll see you in the chat room. Okay.
See you, Dale.
Thanks, Kay. Thanks, Ryan.
Bye, mate.
I'm going to show something, which I haven't shown before, but this is the the Fed's balance sheet, and if you look for one reason why stocks are holding up, equity markets are holding up, one-off. But if you look at one reason, it's this. So we are, this is last month, so I think we last week, so we probably will have to wait for a number this week. No, it's actually already 2 weeks ago. For as long as this thing stays above 8 trillion, I think that the equity markets may not get yet into panic mode. This is where we were pre-pandemic, and this is what's been added. So basically, no, actually, sorry, this was pre-pandemic. Sorry, guys. But anyway, the case is still there, as long as we stay above 7.85. But if you look at this, that means that since the pandemic and all the liquidity that's been added into the system, there's still plenty of liquidity in the market. So I reckon the equity markets, unless we see the US economic data really start to deteriorate and fast, that the equity markets are probably looking at this as well. And if you look at the total liquidity still in the market, even QT included, look, we're just back to levels where we were just before this. This is the regional banks scare and injection, right? We need to see more data here, but it is actually a little bit lower right now with the weeks going through. But for as long as there's that much liquidity in the markets, perhaps for the longer term, and Stella has been speaking about it even technically. If you look at the S&P, there's nothing really bearish about it. We're still in this uptrend, still making higher lows right now. If we start to get below 43.30, I think the party may be looking a little bit different. But that's one of the reasons that liquidity, why the markets are still here in the equity markets. Okay, so this is going to evolve. This is going to come down lower. We have to watch the RRP as well. We have to watch what the money market funds are doing. But that still plays a big part if you look at the really big global picture of why equity markets are still doing well. And we also had, since the start of this year, so many warnings that everybody, actually, all the banks, all the big asset managers were warning that this year would be difficult. So they were underinvested on equity markets as well. And I'm taking the S&P, but everybody knows that like the techs are even more impressive than this. But okay, never say never. It can really come down, but I think we need to keep a bit of an eye on this QT as well, running in the background, to get an idea where the liquidity will really start to tighten. And perhaps on a pure technical view is that if we start to get below 8 trillion and below this 7.85, perhaps then you see the RRP declining much more, and perhaps the money market funds starting to move as well, and that may in turn start to weigh on equity markets. That was just an aparté that I wanted to do. We are talking about fundamentals here, and we are talking about big pictures here, so I thought it was an interesting one to throw into the mix today. Euro dollar, as I said, so I don't know, it's hanging around here, hanging around this 109 still magneting, but okay, this one had been broken, but then again we're holding here. We're really going into the point of this triangle, so there may be a big move starting to unfold. I think you look at a couple of levels here. First of all, the highs that we put in lately, it's actually 109 the figure, but then 109.25, prior highs here, 109.30. If that starts to go on a bad number in the US, and I think today the surprise number will be a bad number, but assuming that after the ADP, we're getting a good NFP report, and then we have to look at the subdivisions, the sub data. But if the report is good, since we have seen a lot of those euro crosses also recovering over the past 24, especially 24 hours, big recovery in the euro crosses. I'm kind of thinking that the euro dollar is a little bit held up by those euro crosses as well. So a good report could finally break finally be the straw that breaks the camel back. So keep an eye on 108.30, 35, the other side, and then one low 108 the figure. The 108 the figure is really going to be your test here. I think it's a big enough level that we have been trading around. Ryan has been highlighting this as well. So 108 the figure is the one. 108 25 35 on 109 sorry 25 35 on the other side. Of course, with what's been going on in the dollar yen, we told you about everything that's going on. The dividend sales on the Nikkei, the rest of the stock markets coming a little bit down, Asian stock markets coming down, and then the carry trade unwind. If you look at MEX yen, it's really gotten hammered over the past 24 hours. Really, we had a little bit of a starter in the Asian time zone yesterday, and then during the European and US session, and even also overnight, we've seen more of it happening. Now, for how long can it last? So today, it's probably going to be the dollar who tells us whether it's going to last or not. And I have a bit of a red zone here around 142.5. I think this looks a little steep to really taking into account, but you're looking at 142.5, and then it's going to go like every 75, 80 points or so down. There's of course a big level here, which is around 141 to 141.30. That's another trend line coming in, and multiple FIBs in there as well. So that for the downside. If it's a bad number this afternoon, contrary to what we've seen to the other US data, if it would be bad, and looking at the mood and what the market is in the process of right now, your dollar yen could really see that shakeout, and perhaps, since it's driven by other factors as well, have a pretty decent shakeout. Why not go down to 141, as Ryan was already saying as well? But then we need to see how bad the report really is in the US, right? And then we need to keep an eye on where the yields are going to head. But it looks fragile right now, and the market is probably taken a little bit by surprise, because higher yields elsewhere should not have put the dollar yen right here. But other factors have been driving it lower. And a bit of a panic move yesterday and overnight in stuff such as Rand yen, MEX yen, and the rest of the yen crosses have been just, I think, following those carry unwinds. So that for the downside. What happens to the top side? I think it's 143 around here, 143.50, 60. If that starts to go on a better number and hold, we have to hold it, okay? If that starts to go on a better number, then it's likely that we are going back at least into the mid 144s, okay? Because the move may be kind of done. Then we'll have to see on Monday, because there's still this dividend stuff going on Monday. If we see another leg or so retest lower and see what happens there on the Monday morning Japanese market. But if the numbers are good in the US, we could be near to the end of this correction. Keep an eye on 142.5 for starting. And really, those are the two main ones I'm going to look at for the US report. In Canada, the Canadian report, we're through 133.25. We are through 133.40. That's going to be your zone to watch now. Get a little bit of an overshoot, perhaps down to 133, the figure 132.90. Allow for that on a good report. But if that starts to hold, and we're getting back above this level here this afternoon on the combination of the two reports out of the US and Canada, that's going to be your benchmark. If the Canadian report is bad and the US is like normal, I would say, there's a fair chance that dollar CAD is going to continue to push regardless what happens in the oil and gas sphere. And then we could be in for a move up to 135s. I'm looking at the clock. I'm going to stop it here, Ryan. I think we've talked enough.
Thanks, mate. Yeah, I was going to match you on the dollar yen. I think that 143.50 top side is important where we close today. If we close below it, might mean that the upside is harder to get through again. It's going to be hard work getting up to 144s and back. I think, yeah, if we close above it, then maybe this has just been a short-term bit of a flush out, and we're heading back into the 144, 145 range. So for any pair you're trading, always note where you've closed, because that can give you a signal as to what the market will be doing next. Anyway, it's Friday. It's the weekend, near enough, after we get over the NFP. So I do wish you all the best of luck if you're trading it. If you're not sure, don't guess into the number. Don't do a trade thinking, I think the NFP is going to be this, so I'm going to trade it that way. Wait to see what happens. Trade the reaction, whether it's a correct reaction or an incorrect reaction. Thank you very much for coming to the Flow Show and giving us your support here. Do make sure you spread the word on the Twitter or threads or the toilet door, whatever you see us posting, and have a great weekend. Thank you to Kate and to Stell for all their wonderful input as always. Have a great weekend, everyone.
Nice weekend, everybody.